Markets move when people move together, and understanding that early is the real advantage. When we move together, we shape outcomes, build wealth, and secure a safer future. US equities closed modestly higher, with the S&P 500 up 0.4%, led by strength in energy and financial sectors. Investors balanced better than expected inflation data against rising Treasury yields. The Nasdaq underperformed as tech shares faced pressure from shifting bond market dynamics. The market is digesting inflation signals and interest rate expectations. Defensive sectors outperformed, but cyclical areas like energy could maintain momentum if commodity prices hold. Watch tech for signs of stabilization as bond yields settle. April inflation data showed core CPI easing slightly, reinforcing the Fed's cautious approach. Traders are pricing in a less aggressive rate hike path. But central bank communication remains key. Upcoming Fed minutes could clarify policy stance and guide market direction. Inflation moderation supports a slower rate hike trajectory, which could boost risk assets. However, any hawkish tone from the Fed would likely pressure rates and growth stocks. Position for volatility around policy announcements. Energy stocks led gains on firm oil prices, benefiting from supply concerns and geopolitical tensions. Financials also advanced, supported by higher bond yields, improving bank net interest margins. These sectors remain attractive in the current environment. Energy and financials may continue to outperform if oil prices sustain and yield curves steepen. These sectors offer defensive qualities with upside leverage to macro trends. Technology stocks struggled amid rising treasury yields pressuring valuations. The semiconductor subsector was notably weak as concerns over demand and inventory adjustments persist. Investors remain cautious until clearer signs of demand stabilization emerge. Tech remains vulnerable to rate volatility. Avoid chasing strength in semiconductor stocks until inventory and demand data improve. Defensive positioning remains prudent. Energy continues to show resilience, driven by supply constraints and geopolitical risks. Major integrated oil companies posted strong gains, reflecting robust cash flows and dividend stability. This sector is benefiting from a favorable commodity backdrop. Energy stocks provide a hedge against inflation and geopolitical uncertainty. Exposure here can balance portfolios facing tech and growth sector headwinds. Semiconductor stocks continue to face headwinds from cautious demand outlooks and inventory corrections. Despite recent rebounds, supply chain normalization and end market softness weigh on near-term fundamentals. Investors are wary of earnings guidance revisions ahead. Semis may remain volatile and underperform until clearer demand signals emerge. Avoid aggressive exposure and monitor guidance closely. Overall risk sentiment is cautiously risk-on, supported by easing inflation fears and stable commodity prices. However, elevated bond yields and geopolitical uncertainty cap upside. Traders are positioned for selective sector rotation rather than broad market rallies. Maintain balanced exposure with a tilt towards cyclical sectors poised to benefit from macro tailwinds. Avoid broad risk-on bets until volatility subsides. Semiconductor stocks are showing early signs of bottoming after a prolonged correction. If demand signals improve over the next week, this sector could experience a significant rebound. Monitoring inventory data and order trends will be critical to timing entries. Positioning selectively in leading semiconductor names on confirmed demand, stabilization could capture upside. Use tight stops given ongoing uncertainty. Highest conviction setup, NVDA. NVIDIA's leadership in AI and data center technologies positions it well for long-term growth despite near-term inventory headwinds. The company's strong product pipeline and customer demand signal resilience in a challenging semiconductor environment. NVIDIA is likely to consolidate near current levels while investors digest earnings and inventory data. A positive update on demand or order momentum could trigger a strong bounce, attracting renewed institutional interest. If this breaks, a sharp downward revision in demand guidance or worsening inventory metrics would undermine the recovery thesis and pressure the stock further. What happens next? Markets will remain range-bound with selective sector moves as investors await clearer inflation and Fed signals. Energy and financials may extend gains while tech consolidates ahead of earnings updates. A hawkish Fed minutes release or unexpected geopolitical escalation could spike volatility, driving a risk-off sell-off across growth and cyclical sectors. Tomorrow watch Fed minutes release timing and tone, upcoming inflation data revisions, oil price movements amid geopolitical news, semiconductor inventory and order reports, bank earnings surprises and margin updates, Treasury yield curve shifts. Markets move when people move together, and understanding that early is the real advantage. When we move together, we shape outcomes, build wealth, and secure a safer future. Real wealth starts with discipline, health, and strong relationships. Take care of yourself, take care of the people you love. Stay focused, keep learning, and stay informed. Until next time.